A family making $150,000 a year can still become house poor. The most dangerous number in home buying is not the payment you want. It is the payment the bank says you can survive. In this video, we are breaking down how much has a $150,000 household can actually afford without getting trapped by mortgage stress, hidden housing costs, and zero breathing room. Start with the math. $150,000 per year equals $12,500 per month in gross income. That gross number matters because mortgage qualification rules are usually built from gross income, not take-home pay. Now let's talk debt-to-income ratio, or DTI. This is one of the biggest numbers lenders use. Consumer guidance often points to roughly 28 to 35% for housing-related debt, while some underwriting rules allow total debt ratios that can go much higher. That is why approved does not automatically mean affordable. This is the first big lesson. Approval answers one question: can this loan get through underwriting? Affordability answers a very different question: can your family still save, breathe, fix problems, and live without panic after the payment hits? A strong starting point for a safer housing number is around 28% of gross monthly income. On $12,500 per month, that lands around $3,500. But here is the key: that is not just principal and interest. That is all-in housing. All-in housing means everything attached to homeownership, not just the mortgage. It includes property taxes, homeowner's insurance, mortgage insurance, possible flood or supplementary insurance, HOA fees, utilities, maintenance, and repairs. If you only budget for the loan payment, you are not budgeting for the house. Here is the part people forget: when you buy a home, you may also be taking on utility bills and service costs that renters often do not fully feel in one place: electricity, gas, water, sewer, internet, trash pickup, lawn care, landscaping, snow removal, pest control. That is why two homes with the same price can feel completely different financially. One property may include some services through HOA dues, another may hand those costs directly to the owner. The price tag does not tell the whole story. The monthly burden does. If this family has no car loan, no student loans, and no credit card balance, then a $3,500 all-in housing number may be a reasonable starting ceiling, not a target you must hit, a ceiling where caution begins. Now let's make it real. Add one car payment, a student loan, and a credit card minimum. Now $1,400 is already leaving the household every month before housing. Same income, totally different affordability. And then comes the upfront cash trap. Buyers focus on the payment and forget the entry cost, down payment, closing costs, moving, utility setup, appliances, furniture, immediate repairs. If buying the home drains your emergency fund, that house is already more dangerous than it looks, because the first repair will not wait for your savings to recover. And when families buy with no cushion, the credit card becomes the backup plan. Another trap is assuming today's payment stays frozen forever. Taxes can rise. Insurance can jump. HOA fees can increase. If your payment is built right at your limit on day one, even a moderate increase can turn a tight budget into a broken one. You might be house poor if you cannot save every month, if one repair goes straight on a credit card, if your payment depends on overtime, if you emptied your savings just to close, or if you are scared of every bill that hits the mailbox. For many families earning $150,000, a safer all-in housing range may be somewhere around $3,000 to $3,500 a month, and lower if they already carry debt. The right number is not the maximum you can qualify for. The right number is the payment that still leaves margin. Before buying, ask 5 questions. Can we still save every month? Can we cover repairs without debt? Can we survive a hard month? Are we counting the full cost, not just the mortgage? And would we still choose this payment in a bad year? So let's recap this clearly on a $150,000 income. The danger is not just buying too much house. The danger is buying a payment that leaves no room for taxes, insurance, utilities, repairs, HOA costs, or the unexpected. Here is your challenge. Before you shop for a house, write down your true all-in monthly housing number, not the bank's number. Yours. Include taxes, insurance, utilities, maintenance, and one line for unexpected costs. Then ask yourself one question: would this payment still feel safe in a bad year? If the answer is no, it is too much house. Subscribe to Family Finance with Daniel for more data-driven family finance breakdowns. And in the comments, tell me this: what hidden homeownership cost do you think most buyers forget? Because the families who win with money are not the ones who buy the biggest house. They are the ones who leave themselves room to live. Bank approval is not a budget. Margin is safety. Before you buy a house, calculate your real all-in monthly cost and ask yourself whether it would still feel safe in a bad year. Then comment below with one hidden homeownership cost buyers forget. And subscribe to Family Finance with Daniel for more data-driven money breakdowns.